When we talk to investors today, some of them are worried about how equity market valuations are quite stretched. And others are worried about what if they miss this rally by staying outside and not participating. But should you worry at all when it comes to investing? We feel that with all weather investing, you don't need to worry. If you think about this year's best performing asset class, was it really equity? There are many different asset classes for you to participate in, for you to feel safe in, and for you to create wealth sustainably. If you'd like to know more about all weather investing, join us this Saturday for our webinar at 10 a.m.
The risk in SME markets. Firstly, there is no doubt that we need to have very robust SME ecosystem. When I say ecosystem, it should start with ease of doing business by which you start an SME, ease of finding capital, which means you should be able to find the right seed capital, the correct angels, and then you must prove your concept early enough so that you come to a Series A stage at which you need to find the right patient capital for growth. Typically, at that stage, your concept is proven, you are clearly showing visibility of the economic opportunity for your SME in your industry and in your business. You are able to show that to investors and give them the confidence to give you patient capital. When I say patient capital, capital that will wait for 5 years before it can be monetized through an IPO or through a sale of the business. An SME definitely needs 5 years to build its model to scale. At that point, probably an SME is ready to come to a main board and again raise capital and go towards further growth. This cycle requires time, the right people, and above all, strict adherence to tenets of financial accounting and corporate governance. If you are able to do this for a period of 6 to 7 years, 2 years of angel, seed, and up to Series A stage, and then 5 years of growth investing, then I think an SME will be market ready. Look at how SMEs have listed in India and try to identify how many companies have followed this pattern, and you will find hardly a handful of companies which have evolved, grown, and then got listed. So, what are the companies that are getting listed now? The companies that are getting listed are existing businesses where a promoter has a strong incentive to capitalize, to give a value to his business. Is this wrong? Answer is no. Absolutely not. It's well within his rights. And when you capitalize your business, it is the promoter's duty to follow the level of corporate governance that a listed company should mandatorily maintain. Now, a few days back, there was an IPO which was completed, but at the day of listing, SEBI told the Bombay Stock Exchange, which approved the IPO, to withhold the listing and to move the company to an escrow account, to move the monies raised in the IPO into an escrow account which shall not be accessed. Effectively, SEBI put a freeze on a SME IPO after the company raised the money but before the share listed. Interestingly, a day before this event, the grey market premium on this issue, which was at roughly 70 rupees, was 95 rupees, which means just that application was meant to flip that issue at nearly 135% profit within that 8-day cycle. Now, if you go into the list of shareholders who have participated in this company's capital table before the IPO, then you will find a far more interesting story in this company. I am taking this company as a typical example. I am sure there are stories like this in every company. Now, corporate governance in a SME starts with the cap table. Are you having patient investors on your cap table or are you having flippers? Have you created adequate public representation in your cap table pre-IPO and post-IPO, or are you encouraging concentrated ownership in your company? This is the smell test of corporate governance even before an IPO. Only if a company passes this smell test, you can actually conclude that the company is investment worthy. Alright, then who does the due diligence in an IPO like this? That's the biggest Achilles heel of SME investing today. The investment banker is supposed to do the due diligence, but when you see an instant like this company which has been stopped in its tracks after the money has been raised by the regulator, it means that the due diligence has not done its job, or the due diligence has raised more suspicions which come a day too late. How can you stop a listing on the morning of the issue? You should have stopped it before it raised money, right? That is the logical thing. Now, the reason why this issue was stopped is very, very interesting. It relates to the end use of monies raised by the company. Now, this is 44.7 crores raised, and about 17 crores was meant to be used to buy a software from a company whose paid up value is 1 lakh rupees and which has not even filed income tax returns for 3 years. And who blew the whistle? Some anonymous person wrote to the regulator. My fear is that in several companies you are going to see people walk out of the woodwork and write like these and create a series of issues related to corporate governance and failure of disclosure. There is another thing that I am increasingly hearing. A promoter has multiple entities in the same business. He puts one entity on the SME exchange, more often on the BSE. Then he transfers business from another private entity to this entity. Society sees this as growth and assumes that the company will grow at the same rate in the subsequent years. What has he done? He has a company with turnover of 60 crores. He has another company with, let's say, 50 crores. He adds this 50 crore turnover into the listed company after the listing. It appears that the turnover of the company has grown from 60 to 100 or 110 crores. So you think that company has grown by 80-90% and start giving a PE for a company which will grow at that rate. When you do that, the valuation of the company blows out. Lots of retail investors come with 2 lakhs to invest in that company. Everybody believing that this is a great growth story. But actually what has happened? He has business in 2 pockets. He has taken business from one pocket and put it into the other pocket. Has he created growth? I leave the answer to you. So how can you give a PA expansion to such a company? This has been another template that has been playing, which raises very serious issues of corporate governance. No disclaimer or disclosure that this is the business change in the related party. You only have to disclose in the listed company, right? You don't have to tell that the other company's sale went down to 0. So people are all like a bunch of blind men describing an elephant when it comes to judging SME companies. It is very easy to take and dust up patriotism, India story, we are going to grow for the next 20 years. All that is fine. I also believe in that and I am in your camp. But are you passing the smell test of corporate governance? The answer is a clear no. And then there is a third one where people who assist these SMEs to come public are actually trading in these stocks very quickly and moving on. If there is a pre-IPO placement in a listed company, there are ways to control the sale of those shares through regulation, but there are none in an SME. So, it has become a space where you can easily flip money. Now, where is all this going to lead to robust growth companies? That's the fundamental question that we need to ask ourselves. If this is the template and if this is the basic model of corporate governance, how are we going to ensure that this is sustainable? Don't look at how much money was made. Don't look at how much appreciation happened. Think of what can be the downside after this happens. Because the majority of the investors are only going to experience the downside. A very small section of people experience the upside in these kind of manipulative blowouts, and most people only experience the downside. Now, the reason people like us are saying this is so similar to 1994, when small companies listed, raised small monies, stock price went up, promoters sold, company vanished. That was the final outcome. I don't think we can bear such an event now because the valuation of SME exchange is so high. In 4 years, between the two exchanges, they have raised 12,500 crores, and the market cap of that space is well above 1 lakh crores. So, if you have, let us say, a 25% loss, we are talking of nothing less than 25,000 crore loss to investors. Now, if promoters are owning even 50% of this 1 lakh and 25,000 crores or 1 lakh 50,000 crore of SME valuation, you are looking at a public investor losing 1/3 of the money. And that's not a small sum. It's not something that investors can bear. So, we need to urgently get our house in order and address the entire value chain, the entire activity chain of raising capital, capitalizing a company, monetizing a business, listing it, and ensuring that the prospective investors are told everything they need to know, providing them with a reliable due diligence, and making the company fulfill the basic tenets of corporate governance before, during, and after listing. Now, this is heavy lifting, if I may say so. I am not sure who is going to do this, but I think every one of us needs to do this and be a participant in building a robust ecosystem where you get reliable companies to invest into and ensure that companies with ulterior motives do not misuse this ecosystem. This is no small challenge. There are no easy solutions. This is a steep climb, but a tough one which we need to somehow capture. Thank you for watching this video.